In this week's market update, German elections return Merkel but bring new political instability. Japan faces an election moment of its own. The UK suffers a ratings downgrade as Brexit negotiations continue, and the Fed sticks to its more hawkish path. The week began with election news, most notably the result of the German general election. Angela Merkel will begin her fourth term as German Chancellor after her Christian Democrat Party was once again returned as the largest party in the Bundestag. That result, however, hides big shifts in German politics. The union coalition that Frau Merkel had led in Parliament can no longer rely on the Social Democratic Party, which lost seats and will now lead an opposition, and so it must now forge an uneasy grouping with both Green and pro-business parties to secure a working majority. Such contortions have been made necessary by the rise of Alternative für Deutschland, the right-wing anti-immigration, anti-Islam party that has won strong support in the old East Germany and Saxony in particular. Investors are digesting the result and view it as broadly hawkish for markets. The received wisdom appears to be that the possible introduction of pro-business voices in the German ruling coalition will bring about a harder line from Germany in discussions with its less well-heeled partners in the Eurozone. So it followed that yields on the government debt of Euro periphery countries rose on Monday, with Italy's 10-year yield up 2.7 basis points, Spain's 10-year gilt up 1.7 basis points, and Portugal's up 2.6. The euro was down 0.4% to $1.19. European equity markets, which of course have seen similar trends in both French and Dutch elections this year, were relaxed about the German result. The DAX in Frankfurt was marginally higher, the region-wide Euro stocks down marginally, with indices in Italy and Spain dragging on it. It wasn't the only election-related news at the start of the week. Japan will complete the set of developed economies going to the polls following the announcement of a snap election to be held on October 22nd. It means that all of Japan, Germany, the UK, France and the US will have held general elections within the space of 12 months. On calling the election, Japanese Prime Minister Shinzo Abe made clear that he wants to fight it on territory of the economy and his handling of the rising tensions with North Korea. On both, he's likely to find voters sympathetic. With Japanese residents forced to take shelter recently after North Korea flew missiles over the country, Abe's tougher recent stance on Pyongyang will find an audience, and on the economy too, Prime Minister Abe has a compelling case. The results of so-called Abenomics, his grand plan to overhaul the country's economy, have been mixed, but the news recently has been good. The latest growth figures show that Japan grew at a rate of 4% a year in the second quarter of 2017, ahead of expectations of 2.5%. Japanese shares ended at a two-year high on the day the snap election was announced. That rise was helped by a fall in the value of the yen, which in turn boosted Japanese companies selling in other currencies. The speculation is that Abe will continue fresh stimulus measures worth 2 trillion yen during the course of the campaign, and that will be positive for equity markets. Back in the UK, and the news flow is being driven once again by Brexit. On Friday, Theresa May spoke in Florence in an attempt to unlock negotiations between the UK and EU that appear stalled. The main news from the speech was confirmation of the Prime Minister's desire to agree a two-year transition period starting from 2019 when the UK officially leaves. This aim has been inferred before, but now this was confirmed in the speech. There was also progress of a sort on the financial terms covering Brexit. Mrs May's lowball offer was for the UK to pay in the region of 20 billion euros during the transition to cover the UK's commitments. That's likely to be countered with demands of higher figures from the EU. Overall, the speech gave some assurance for business, if only in a limited way. A transition period was being opposed by some Leave-supporting politicians, so confirmation that the PM backs one means companies will have less to fear of a cliff edge arriving in 2019. On arrangements beyond that, however, there is still much confusion. The Prime Minister said that neither European Economic Area rules which govern Norway and Switzerland, nor the deal struck recently with Canada would suit the UK. As such, huge uncertainty remains when it comes to Brexit. And that uncertainty prompted the ratings agency Moody's to downgrade the UK from AA1 to AA2 last week. Moody's said it took the decision after judging that the Brexit vote would be negative for the UK's medium-term economic growth. It warned ominously that Moody's does not expect growth to recover to its historic rate over the coming years. For its part, the Treasury responded that Moody's was basing its forecast on an out-of-date and overly gloomy assessment of the UK economy, which has been proved wrong since the vote to leave the EU. That view was helped by better than forecast public sector borrowing figures last week. In currency news, the pound dipped after the downgrade last week, but edged higher against the euro after the German election results. Against the dollar, the pound weakened slightly to $1.35. UK shares started the week slightly lower, losing 0.5% to 7,274 for the FTSE 100. Benchmark 10-year gilts yielded 1.37%. Notable corporate news this week comes from AG Barr, Thomas Cook, United Utilities and Purple Bricks. In US shares, there's little sign of panic in the face of the Federal Reserve's confirmation last week that monetary tightening would continue. On Wednesday, the Fed restated its expectation of 1 further interest rate rise this year and 3 next, while the start of the giant unwinding of quantitative easing in the US is expected to go ahead from October. The Fed confirmed the more hawkish tone despite the pressure of weakening inflation that suggests growth remains fragile. Investors will look for further clues when head of the Fed, Janet Yellen, talks to the National Association of Business Economics in Ohio on Wednesday, while there's news on US inflation and the jobs market as well. US shares held their nerve and the S&P 500 was steady above 2,500 at time of writing, hanging on to gains made last week before the Fed made its announcement. In commodities, oil continues its recovery with the price of a barrel of Brent crude now at $58, the highest level since 2015. The gains have been made after signals that the excess of oil built since 2014 is now running low. Also applying upward pressure were warnings from Turkey to Iraqi Kurdistan, which is due to vote in a referendum on gaining independence from Iraq. Turkey has been opposed to Kurdish separatism within its own borders and fears an expression by Iraqi Kurds towards independence will foster unrest in Turkey.